You ready?
Yep.
Ready, set, go.
All right. I'm rusty. Hey, hey everybody. I'm Zarina Harris. I am here with my fellow LOI members. Everybody say hello.
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 We've got Sabrina
Why
Allen.
sound excited? Just don't sound
It's a long weekend. And so
We're just coming off the 4th and everybody's hungover, so yeah.
I'm not hungover. I was flying.
I'm not hungover. I don't drink. So they're speaking for themselves.
Yes, I wasn't drinking.
I was a good boy this weekend. I only had a few beers.
Yeah, I didn't. I had one, so I was very good.
That's a lie. All right, so
That's the truth. This is LOI.
So we're going to tackle today kind of a topic that I have not seen done really in the industry. It's not something that's talked about because, again, one of the missions here at LOI is really just expose the truth. And so sometimes the truth is not, it's not sexy. It's not the thing that kind of grabs you into the industry. And the topic we're going to talk about today is contracts. We're going to talk about all sorts of contracts, lack thereof, what you need to watch out for, and why they are important in operating your business from day to day and how you protect yourself. So I guess the house expert on this would be Sabrina Allen, the godmother, because she will have you wrapped up in a contract where you offering your firstborn. So we're going to go to her first. And I want to ask first, what kind of contracts in general should any person saying, hey, I'm a note investor? And if you say, hey, I'm a note investor, I should have XYZ kind of contracts. What are those?
One of them should be a confidentiality agreement. The other thing is that they should have a purchase and sale agreement and maybe have a couple of different purchase and sale agreements. And if they plan on brokering loans, they should also have a broker agreement to also put in front of their potential end buyer.
So I want to stop there because I'm notorious for like working with people who I consider friends or people who I know and have a relationship with. So I probably have NDAs on like 50 to 60% of the people I actually show notes to, which is not good. I'm not recommending this. But that happens a lot. There's a lot of like operating on good faith in the industry. Would you guys agree with that?
I would agree, yeah.
Yeah.
Mm-hmm. But you know what operating on good faith does, Zarina?
Get you burned later?
Eventually you'll get burned.
Eventually you'll get burned because you get comfortable. And I'm not going to name names, but there was a big company out there in Orange County who started doing deals with multiple people. And, we were deploying millions of dollars at a time, $1 to $2 million a month. We get an exhibit A, we see the loans, we see the contract. It all looked the same, but down the line, what they started doing is they started changing language in the contract, which changed the time frame that we would get collateral, which would change the time frame of service transfer. All of these things started happening, and then it started, like we were missing $500,000 in notes, we were missing $1 million in notes. Now we're up to, I think we're missing about $4.6 million in notes that we need to have replaced.
You talking about right now?
Right now, this is real today. Mm-hmm. And we're currently in litigation with this particular company out in Orange County. I really can't say much more about that than that, but yes. But it was one of those good relationships that happened, and we were trustworthy. We were trusting one another, and we were operating on good faith. I mean, there would be times where they would send us over some stuff. There'd be no contract. Oh, go ahead. You guys can go ahead and do whatever you want to do with these loans. So it appeared that we had one of those good old boy relationships. Mm-hmm. But now we're in the time of we're needing loans replaced. So we had purchased, a lot of California loans behind performing first, and these were seconds. And now they want to replace them with non-performing loans in New York behind a non-performing first. That's not equivalent to how we priced and how we structured the deals. So now how do you fix it? Because now we can't even get on the phone and have a civil phone call. And because of the contract and the language in the contract, I think that's a part of why we are where we are today.
So this was something that kind of developed over time because you're very comfortable with this person. And when they sent over the contract, it's not something that you were going through with a fine-tooth comb because you'd seen it before. Mm-hmm. That's how they were able to slip in certain language in there because you weren't watching it every single time you got the contract.
Right. And legal had reviewed and approved the first initial contract. Mm-hmm. And then it looks the same number of pages, but what you're not looking at, the font size has changed. The print is smaller. Just slick stuff people do. So this contract was 10 pages long. This contract is 10 pages long. But if I change the font, just by a little bit, and the margins, I can put a little bit more on this, and I still got a 10-page contract. So it still appears to be the same. So even when you look at the the number of points, point 1 through 50. On a purchase and sale agreement, but if you're not looking to see if there's still A, B, C, D, E, and F to basically protect each individual, and I'm not giving any particular language that should be in there because I don't want to give any type of legal advice to anybody, but I'm just making little suggestions that if you are detail oriented, if you pay attention to, it will actually start standing out to you about what people are doing in reference to manipulating, contracts.
And, the other thing too is, yes, if you know somebody, sometimes it's okay to go ahead and move forward with that deal. But the thing is, and what people need to know is that if you're wronged in the industry, you get on a blacklist really quick, and people talk. So if you're on a blacklist, you're probably not on a blacklist with just one individual. You're on a blacklist with many. So that's important to know.
I have a really long blacklist, so I just want to throw that in. I do.
We have one too. We were contemplating on putting our blacklist online on our website and just kind of letting everybody see it, just because we were so angry at some of these people. But I don't know.
Is that legal? Like, let's just do a side note. You can't do that, right? You can't publish your blacklist.
I don't know.
No,
I really don't know.
We don't want to get sued. We don't want to end up in court. We don't want to end up, So this is true. This just happened. So somebody in New York who just think that the sun rises and sets on his behind got sued by somebody in California, and I won't say if I feel like the lawsuit was if it was fair or not, but they hit him with the lawsuit. He says, you let them know that if they don't settle with me and fix this, I'm going to countersue them. I'm going to countersue them for slander. I'm going to countersue them, and they're going to have to pay my legal fees. But are you going to execute the document that they need you to sign? Well, I'm not able to do that. Well, can we just go through the process on how we fix this versus everybody getting their panties all in a bunch, getting all upset, and let's everybody make this a win-win situation. But when emotions get involved and money gets involved, and you're dealing with family money a lot of times, and some of the bigger entities,
right?
It just gets out of control, and then nobody wants to talk, and it becomes very, very uncomfortable.
So let's start with the basics. Let's start with one of the easiest contracts that people should have, which is a non-disclosure agreement. And I say should because I've had experience, in Sabrina, you've had experience with people who say they're note investors and they don't even have a non-disclosure agreement, which is kind of like saying I'm a basketball player and you have no tennis shoes. It's just something that you should have. So you want to speak on that a little bit, the lack thereof, and then what probably should be in a non-disclosure?
So it's really funny. I had a nice lady contact me and asked me if I wanted to look at some notes she had for sale. And I said, well, yeah, but why don't you shoot me over your NDA? I'd just like to take a look at it. Well, I don't have one. What? You don't have one? No, I don't have one. So you don't have the basic document that, basically states that, this information that you are getting ready to give to me with people's social security numbers on it, their property addresses, their first name, their last name. Bankruptcy information. Even some of this information is public information, but not all of it. So now you're breaching a confidentiality without any type of an agreement with somebody who could basically take your information and sell it to people who actually steal identities, do whatever. Everybody in the industry is not on the up and up. So just that one basic thing is a confidentiality agreement that you're not going to misuse or mishandle personal information which belong to our borrowers that could put us in jeopardy of disclosing information that other people shouldn't have. Making sure that they don't end up on a robo list, somebody calling constantly, their social security number being misused or sold for fake ID.
That's a big one.
All of those things. I mean, like, that's as simple as a non-disclosure. That's an NDA, a confidentiality agreement. And the other thing is that sometimes if you're doing something, you're not disclosing that you got my stuff, because I don't want everybody to know what I got for sale. You're going to keep my information. You're not going to disclose where you're getting this information from. Now, if you got a little bit of common sense, when the trade is done, there's an assignment and there's an allowance that will relate back to me eventually. But that's not for you to just put out there that I want everybody to know that I got assets for sale right now. I mean, those are just simple things that just burn my butt, and people just get to running their mouths and talking too much.
Comments, Joe or Sean?
I agree with everything there. One of the things we do to protect ourselves, because in our business structure, we bring investors in, and in order for us to bring investors in, we have to vet them. And the vetting process is not just for us to understand whether or not they're able to invest with us, but it's also to meet certain regulations, SEC regulations. And so we kind of combine our non-disclosure along with some of the vetting questions that are required of us. And we throw some language in there related to brokers, because if we do broker a deal with them, we want to make sure that we're covered. So, and I know, Sabrina, that you had mentioned before that you like to separate those contracts. We actually have them separated, but in one large contract. So,
but we don't. We do have a separate broker agreement we would use when we do a trade with an investor. So we don't have it inside that contract, the actual broker agreement. So.
Right. And then purchase agreements and then all that are separated as well. But we do try to handle a lot of it up front when we do the vetting part of it with our
but what's funny is we would what was funny is that we would see lots of tapes from all over the place, and we receive tapes from places we don't even have an NDA set up with that company. So it's out there. And so you gotta question in yourself, okay, why am I receiving this tape? Do I have a relationship with this company? And it's important to have an NDA completed and signed.
So the other thing is that if you don't have an NDA with someone, we're not buying candy bars, you guys. We're wiring thousands, hundreds of thousands of dollars, sometimes millions of dollars to people.
Right.
And if they're operating and they're not doing their business the way they're supposed to do, why would you send them any money? You better not send them mine. I mean, I'm serious.
Have you ever gotten any pushback from somebody when you sent them an NDA? Any of you?
No,
no.
Well, I will tell you, somebody will say, well, what is an NDA? I even had somebody who's really big in the industry who's in New York, not the one I was just referring to, but another guy. He didn't even know what a RESPA letter was, and he'd been on the tour bus with you-know-who, and had been a couple of places and sitting on tours, note tours, and didn't even know what a RESPA letter was. And I'm like, I wouldn't tell anybody that. Don't
the amount of people out there doing their business half-cocked and don't know that they don't know stuff is absolutely dangerous. Absolutely dangerous.
I was just like, you sound like a millionaire idiot is what you sound like. I'm like, how have you managed to become a millionaire and you don't even know what a RESPA letter is? I mean, it's possible. It's really possible when you have other people to think for you. But I really would like to know the process myself versus paying somebody to think for me.
So a non-disclosure is definitely a document that somebody should have. We kind of touched on broker agreement. Before we get there, I want to make a distinction that there's a difference between a purchase sale contract or a purchase agreement and a broker's agreement. You want to talk about the differences between those two things?
You cut out, I'm sorry.
No, I was saying that a purchase sale contract is different from a broker's agreement. And if you want to touch on what are the main differences between the two, and do I need both, or only if I'm brokering do I need a broker's agreement?
Well, only if you're brokering, you need a broker's agreement. And that broker who has brought that deal to you, you need to figure out how they're going to be paid. And sometimes that should be disclosed in the purchase and sale agreement. You know, if there's something, you know, there should be some language added if there's a broker involved. How is that broker going to be paid? Are they going to be making, you know, X amount of dollars per loan? Is it going to be a percentage? What is that? And then who's responsible for paying that? So I think that disclosing how the broker is making money or how the broker is going to be paid, depending on who your seller is, makes them think that they could actually get more money for their loan. So be careful on doing that, because they're like, if they're paying $1,000 per loan, I could be making more money, because some sellers are just greedy and they want to make every dollar possible. So again, you have to, you know, you have to be careful on what you say, when you say it, how you say it, but you have to know who your end seller is. You know, some of the bigger funds aren't going to care that there's a broker involved and they're making money. They already have a dollar amount set that they need to recover for these assets, and that's it, that's all. But then you may have someone who's doing a co-buy, which is different than you brokering a loan. And basically in a co-buy, you're getting the assets at the same price that I'm buying the assets at. Again, be careful on what you say and how you say it and who you say it to, because it could just create a mess when you're dealing with people who are very, very greedy in the industry. So sorry to go on a little bit of a tangent, but the broker agreement is something that I would give to you, Zarina, if I was bringing you loans and I was expecting you to pay me because I brought you those loans. Mm-hmm. And how you pay me is really, really important. Is it going to be at the time that I fund the entire project, or you know, the entire purchase, or is it going to be done in increments? If I'm paying you, it's going to be in increments. I'm not giving you your entire commission.
So why?
Why? Because things can go wrong. Things can happen. And I would prefer not to pay you for all of your work up front when your work is not complete. You know, some people say, well, the responsibility of a broker is just to bring you the deal and that's it. Well, that depends on how
I've never brokered that way.
I'm sorry?
Yeah, I've never brokered that way. Every time I've brokered, it's pretty much just as much work after the funding as it is to get to the funding.
Correct. That is so true. But most people think that once the deal is funded, the work is over. It really is not. You got to think about, you know, collateral being shipped, assignments and allonges. You have to think about transfer data, service transfer, all of those things that are important. And how are you going to make sure that your buyer is comfortable with the information that's coming in? And you can't, you know, you just can't make $60,000, $70,000 all up front. You just can't do it. And it has to be done in phases. And I say 25% increments, 25% of the time of purchase and sale agreement. And sometimes you really shouldn't even get it then, because sometimes even when you sign a purchase and sale agreement, there's still no guarantee that this deal is going to close and you're going to be able to fund it.
Correct. Yep. Because things can fall out. Because purchase sale agreement is usually when due diligence starts, and stuff falls out in due diligence.
Right.
So you also mentioned something about a co-buy agreement. Is that something that you would do separate from a broker agreement, or would you bury that language in a broker agreement for the co-buy?
I wouldn't broker it. I wouldn't put it in a broker agreement at all. If it's a co-buy, there should be language that's actually in a purchase and sale agreement. And even though it's a co-buy, there needs to be an agreement between you and I stating that it's a co-buy, and you can't hold me legally responsible for something you're buying. Technically, you're buying directly from the seller. So if you choose not to do your due diligence, and even though I brought you the deal and you're buying at the same price I'm buying at, you can't come back and sue me or threaten to sue me because you feel like you lost money when you bought loans at a greater discount that you're going to buy after I've actually gone through all of the hardship, the labor of making sure that there's a full, complete assignment chain. We've actually purchased a loan, and it's not just, a vacant lot, or it's a structure and it's not burned down. So you're taking a greater risk, but you're paying less money. And there just needs to be an agreement that we each sign, knowing that there will be no recourse if something goes wrong after this trade is closed.
I would say that's the importance of having an Exhibit A as well, so that, because some people will do like a co-buy and the only thing that they're contributing to is like the purchase price, and then when it all falls out, we'll just divide it up. I think that's a mistake. I think the assets should be divided up before the funding, so you're getting XYZ assets, and this is what you're funding for, and I'm buying this list of assets, and we're just commingling our money basically. Because what you don't want to happen is someone go in there and say, well, I paid for half of this pool, I'm going to cherry pick what I want. So,
and that, you bring up a good point sometimes when you're doing co-buys. So, Joe, you could be bringing in $200,000. Sean, you could be bringing in $500,000. Zarina, you could be bringing in $1 million. So, and then, the person who brings in the least amount of money, they want all the California loans. Go sit down somewhere. That doesn't work for me. There has to be, so how do you do this? How do you break this up? There needs to be a decision manager, and basically depending on, value, loan to value, equity, however you want to structure this, but based off the money that you actually put in, is how you actually get your chunk of assets, and you don't muddy the water. And people just make this all so complicated anymore, and it's not necessary. If you put in $250,000, when we get to that, when we get to that tranche of money, you get first pick. We go around the table, but once your money is gone, you're done. You don't get a say unless you bring in more money. I mean, it's just that simple. But people, they make it complicated. They think that you got to put 3 legs in and 1 leg of underwear. I don't know.
What?
No. Bleep that.
No, we keeping that. So there's also a section we're going to talk about here, and that's just, so we've talked about non-disclosures. We've talked about brokers agreements and Sabrina's way of sort of chunking that out and making sure that the broker stays in the deal as the deal is still continuing to close, because it doesn't close at the funding like most brokers think it does. So she kind of chunks that out in 25% increments for their commission. And then we talked a little bit about purchase sale contract and some of the language that should go inside of that. But what are some of the things that you have seen or not seen in purchase sale contracts that are actually important? Or what have you come across that were actually ridiculous? Just some things that you've seen in a purchase sale contract that was good or bad.
Well, one of the things that I think that is really good is that you ask your seller for a POA. A lot of sellers don't like to give a POA because it's more work. But if you get that POA, it kind of will help you cure some of your breaks in assignment chains.
And can you explain to the people what a POA is, just in case?
A power of attorney. And a power of attorney basically is recorded in every county that you purchased assets. So you actually record a power of attorney in every county that you purchased assets in from that seller. So on record, you now have the authority to fix things that are wrong. But if there was a chain or there was an assignment broken prior to your seller, you need to ask the seller if they actually had a power of attorney recorded. So then it helps things move along versus trying to go look for signers when you have a break in assignment chain. If you're missing an allonge, or there's an assignment that's not done properly. And there are so many things that can go wrong when you're actually originating a lot of assignments and a lot of allonges, you know, a word could be misspelled, an address could be misspelled, something in the entity could even be wrong. It could be LLC and it needs to be INC. Well, now that assignment is defective and now it needs to be replaced. Sometimes the counties will reject assignments, and now that assignment has been executed and signed, now you got to go back to them. But if you have a POA and you have a POA on record, you don't have to go back. So those are the things, those are the great things that you actually can kind of incorporate in your purchase and sale agreements. Buyback time, you know, like when you can return a loan, if there's something wrong with the loan. If you don't put a time frame in there, you know, it's muddy water, it's gray. If the loan is unsecure because it's been lost to a tax sale, again, if you don't define that, it's muddy water. The other thing that's really, really important in a purchase and sale agreement is that in your Exhibit A, you should have loan level pricing on every single loan. Because if a loan is replaced or needs to be replaced, or you need a refund, what are you going to do? Weight the average of what each asset costs based off the trade? But that could have been one of your most valuable assets in the trade. So if I buy $1 million worth of assets and one loan I'm valuing at $100,000, but on the Exhibit A, there's no value to it or what I'm paying for, and I need that loan replaced, and the seller only wants to give me $10,000 or $15,000, now you're basically upside down somewhat in your trade, because you just took a hit on what you were trying to accomplish in your trade, because you're not looking at the assets the same way the seller was. So if you have loan level pricing on your Exhibit A, it just makes it a lot easier if you have to have a loan switched out, if you have to be refunded on a loan.
The King brothers, have you guys done or seen loan level pricing? And if so, what's your approach to that kind of stuff?
Well, any tape we look at, we always break it down to loan level, and we'll bid it on loan level. And, you know, I'll bid a lump sum, but we have everything break it down on the loan level. I completely agree with that, because like Sabrina stated, that, you know, if you run into an issue, you know, or if you need, you know, certain loans that you further do your due diligence on, and, you know, you find something, then you want to make sure that, you know, you'll be able to assess, okay, what the value of that asset is. But definitely a loan level is how we look at everything.
So I had some investors who had done a couple trades with somebody, they had loan level pricing on their purchase and sale agreement, and then they did a trade and bought, I think, 26, 27 loans. Guess what wasn't on the Exhibit A? Loan level pricing.
Oh.
And they needed to return 3 loans. And the seller wanted to give them less money per loan, even than the equivalent if you actually divided the loans up, you know, and unfortunately, they just served that seller a demand letter from an attorney wanting a refund. I think the seller was offering $19,000, and the investor just put a demand out for $79,000 for their refund.
Oh,
that's a big difference. That's a big difference. But there's no loan level pricing on the exhibit.
So it also protects you as a seller to have loan level pricing in case something like that happens, where they come back to you demanding, no, I want a refund on these 3 loans, and this is what I think you should refund me for.
Mm-hmm.
So it helps both parties, really, is what we're talking about.
Mm-hmm.
All right, loan level pricing. That's very interesting. In my experience, I haven't seen a whole lot of transactions actually have an Exhibit A, and especially an Exhibit A with a lot of loan level pricing on it. I've kind of seen the assets listed, 123 Main Street, 456 XYZ Avenue, whatever, but there's no individual pricing on all of those. It's just kind of like, we're buying these 5 assets for this price. So that's a very good piece of advice. And
that doesn't work for me, Serena. No.
That doesn't work for you?
No.
Not at all?
Not at all.
It just sounds like you've been burnt before, that's all.
You live and you learn.
Hey.
You live and you learn.
So our last section that we're going to cover is really just contracts in general. So I initially, because we talk about things before we start these webinars, we actually do have a plan before we come into these things. Wanted to talk about non-disclosures, purchase sale agreements, and brokering contracts. But then Joe mentioned, let's talk about contracts in general, because they actually have a story with this very specific contract that they got into. And I'm gonna let Joe kind of tell us the story behind that and why it's important to know all of your contracts.
Yeah, so our story starts prior to us getting into notes, and we were in fix and flip for a while, and we wanted to do something different. So we were looking at different types of investment opportunities out there, and one, we met this guy who was a marketing guy who was working for an underwriter. And this underwriter was putting these deals together for a contractor. And we didn't understand the process. We didn't know what we were getting into. We just knew that that what they presented us from a marketing standpoint sounded like it totally made sense. You know, we were looking at, I think on our first one, we were looking at maybe a 60% return on investment in less than a year. So we were like, okay, let's take a look at this. So they presented the property to us. We went out there, we looked at it. It looked like a pretty straightforward flip. The problem is we didn't have any power to make sure this thing moved forward, because we were in second position, along with some other investors to finish off this project. Now, what we didn't understand when we got into the contract was that there were other assets tied to this asset. So some of the money that we were giving them was going to other assets, and we didn't know. That wasn't disclosed to us.
Oh.
So long story short, the contractor got into some trouble, couldn't pay his bills, and the asset that we thought we were funding basically sat there, and it sat there for over the term of what we had agreed on. So now we're looking at potentially going into foreclosure in second position, and we didn't want to take the property back. We weren't in a position to take the property back or take over the first. So what we did was, you know, we didn't do anything. Somebody else came into the picture and said, hey, you know, I'll buy all these assets. I'll put them under my umbrella. This is another contractor. I'll put them under my umbrella, and we'll try to make everybody whole. And so we said, okay, you know, we should have learned from the first experience, but then the second one comes along, and seemed like he knew what he was talking about. Seemed like, you know, he had projects behind him, but in reality, it was the same situation as the first one. So but this one was a little bit different because we weren't in second position. We didn't have any power. We were a member under an LLC, essentially like a fund. So we really were in a power. We didn't have any power at all. So. So my point here is that, you know, the contract that you got to understand what position you're in as well. You know, are you in a position of power? If something happens, what can you do? What is your recourse? And when we got into these contracts, we didn't really understand what our recourses were. We just assumed that, you know, I'll give you an example. When you go to buy a house, you probably have a stack about this thick of paperwork that you have to sign. Do you know everything that you're signing in there? Probably not. You know, so this was very similar. You know, when we signed the papers for this investment, the underwriter had a thick stack of paper for us to sign, and I was looking at Sean. I was like, "Is this right, Sean?" He's like, "Yeah, I think so." You know, shouldn't we have somebody look at this? You know, in hindsight, we should have. But even if we did have somebody look at it, they would have to really go through it with a fine-tooth comb, because there's language buried in it that basically, and we didn't even know where this language was. Even to this day, I don't even know where that language is, but there's language buried in it that basically says, you know, this is part of an overall fund that's funding multiple assets versus just this one which you were sold on. So anyway, long story short, we the second contractor went into default, same as the first. They ended up getting foreclosed on, and we ended up losing our investment, our entire investment. So that was a lesson that we don't want to repeat again. And if I can give any advice to anybody, make sure you understand your contract. Hire a lawyer. You know, read it thoroughly. Try to understand what your position of power is. If you don't understand that position of power, you know, and you're put into some position where you can't do anything or have no recourse, then you have no business going into that investment.
And also the other thing is when you're reading a contract, if you don't understand, ask why. Ask the question why. Just keep asking it. If you don't understand it, hire a lawyer, because it's to, you'll protect yourself. Yeah, at the end of the day, you will protect yourself. And you know, you always have to ask that question why. Why is this? Why is that? What does this mean?
And then we also come to find out later that the underwriter took a huge cut from the contractor. I mean, he was getting paid a lot of money up front, more than anybody I've ever seen. And not only that, but the marketing guy was getting a cut as well. So then again, you got to scratch your head and go, okay, what's going on here? What's really going on? Because now we know all of the other people that are invested with these people, and everybody's having problems with them. Everybody. And everybody's losing money with them. So, you know, we mentioned a little bit before about people going on blacklists. These people are on our blacklist, and they'll continue to be for a long time. And we will, if they ever come up, we will let anybody know who they are and not to do business with them, period.
Wow. No, I have a blacklist, and it's usually people who either said they were going to do something, didn't do it, or people who they just don't have ethics, and I don't want to work with them. One of the most important things you have in this industry is your name, and unfortunately, you know, it's kind of weird being part of LOI because we're sort of the anti-guru in just giving out information that nobody else really wants to talk about because it's not something that sells well, but it's something that's going to save your behind if you get into trouble. And unfortunately, I think there's a little bit of, I guess we could use the word shame that comes with when you do get burned, and people don't want to talk about that kind of thing because, oh, you know, I was trusting, I didn't read my contract. Well, no one wants to admit that they didn't read their contract, that they signed their name to something, but it happens. And unfortunately you get burned and then you don't want to talk about it. And so the people who are actually burning people just continue on and on and on and on. And then we have all these horror stories behind the scenes. So, you know, talking about contracts might sound like something that's a little bit, it's kind of boring. It's not like a super sexy, crazy topic, but it is something that happens every day with people getting screwed over by something. And, you know, like Sabrina was saying earlier, the way that she executes business now is based on past experiences of being burned or past experience of having an issue with either a broker or a seller or something like that. So anything you guys want to put in last minute, like some sort of contribution to some advice to somebody if they don't have proper contracts or have any at all? I know Sabrina gave us like a whole bunch of things that she would do or she recommends, but.
Well, I know a lot of people start with these boilerplates that are out there, and you know, it might be an okay place to start if you're doing like maybe a one-off deal with a family member or something, and you really trust the individuals. But you know, if you start, if you're creating a business, those boilerplates need to be fine-tuned to your business and what you do and the assets that you're purchasing and selling, because those boilerplates won't cover you in all situations. You have to have caveats in there. You have to have all kinds of stuff that that protect you and not just your interest, but your investors' interest as well. So
I just want to say, you know, at least once or twice a week, I get a phone call and say, Sabrina, you know, I'm so embarrassed. I sent so-and-so some money and it was months ago and it was supposed to buy a note. And I'm like, oh, well, how did you paper that up? Oh, well, it really wasn't.
What?
Shame on you. Shame on you. Well, I think they're going to pay me back and they're going to give me, you know, they'll pay me, you know, they'll pay me 10% on the money that was deployed. I'm just like, oh, you know, so again, you know, and so I will say that there are some people out there that they're upfront. You know, you're going to deploy this capital, we're going to give you a return until we actually are able to buy something. But if it's not disclosed up front and you think that you're buying an asset or a set of assets and then you don't, that's just not good, guys. It's just not good.
You know, one of my friends got caught up in this. So this is an investor. He's out of Chicago. And I've known him, we'll call him AC. I've known AC for 4 years, maybe now. And just last year, he, you know, actually wasn't last year, it was this year, earlier this year. I was sending out emails from Note Inc. I don't know how he got on the list. Maybe he likes Chauncey or whatever, I don't know. So I was sending out emails and he just reached out like, hey, how things going or whatever. And I was like, hey, what's going on with you? And then he tells me that basically he got caught up with this particular investor who he deployed, I think, $100,000 with so that that investor could buy some assets and kind of like do a joint venture situation with. And he hasn't seen not an asset, not a dime, nothing. And he's sort of stuck because it wasn't all of his money. So he borrowed money from one of his investors, combined it with his own to fund this deal. And now he has no deal, no assets whatsoever to speak of. And he's just trying to sit here and figure out how he's going to get money back out of this person. And I was like, how did this happen? You're a note investor. You knew better than this. What the heck is going on? Why would you fund a deal to this person? And honest to God, he said at the time, this person that he funded was so like friendly and like buddy, made you feel like you're one of the boys and whatever. You just go ahead and fund this person. And that's honestly what got him over it. It wasn't because he thought the person was more knowledgeable than him. It wasn't because he thought the person, was going to magically make him some overnight millionaire or anything. It was the fact that he was basing a lot of his emotional, prowess and like this relationship that he thought he had with the person, and did a business deal, didn't have a proper contract or anything, and he got screwed. And so that happens a lot. Again, like circling back to what I said earlier, I do a lot of stuff, which is, I'm not recommending this, but I do a lot of things based on relationship because I'm on the up and up. Other people though, they use that to their advantage. And that happens a lot in this industry where someone will sucker you based on them being really nice and kind and like, hey, you're one of the guys and whatever. So I just want to throw that out there. That contracts, it won't 100% save you from scam artists and stuff like that, but it will protect you should something like that come up.
I like the idea of incremental payments. If you can do that somehow, some way in all of your transactions, it makes more sense than giving people all the money up front. I know that you need it on a big purchase, but if you can get around it somehow, that's the way to go. Because you don't know if they're going to walk. I mean, they might have a great contract. You might have a great contract, but they can still walk away with your money. And then you got to go to the court system and fight them through that, and
And they're banking on that. They're banking on the fact that they're going to take your money, walk with it, and it's going to take you a few months to get that money back, and they're floating the money in between.
And the guys the guys that stole the money from us, they're going to jail. And it's just not us. It's that's putting them there. It's all the investors that were involved.
Yeah, it's a group of investors. So there's like 7 or 8 of them.
Yeah. And it wasn't because they wanted their money back. It was because they wanted this person to go to jail. Because it's going to cost them more money to go through the court system than they're going to get back out of it. But this person doesn't belong in society. This person needs to go to jail.
Yeah.
Wow. You wanted to say something, Sabrina?
So the other thing is that sometimes it's not months it takes for you to get your money back. Sometimes it takes years. And I can remember I placed a phone call to even
doing the godmother thing again.
No, I was just checking up on some things. So I called one of my buddies at the servicing company and like, hey, can you tell me if you guys are servicing these assets? Yep. Hey, does so-and-so own these assets? Does who own these assets?
What?
I said, oh, I said, well, there's some assets on as an exhibit on these assets saying that so-and-so owns these. And she said, he never owned these assets. I don't know what you're talking about. And then there was another part of assets that were owned by them. She said, he hasn't done anything in these. Most of these have been lost to tax sale. They haven't been worked in years. And because of the relationships that I have, and no offense, you guys, Joe and Sean, this is a good old boys club. And Sabrina doesn't fit into the good old boys club. And I don't care that I don't fit into the good old boys club. But what I can tell you is that I can pick up the phone and I can call a lot of people and I can get a lot of answers because I've been willing to do the same in return. So it's about the relationships that I've established. I can go to an event and all of these supposed gurus are sitting on stage and talking, and they've been in the business for a hot 24 months, and now all of a sudden they're gurus. But they're not. I come 1995 deep from what I know. And because of that, you can be a guru all day long, but I'll just stay the godmother of notes. Yeah. I'm going to just leave it at that.
I think we're going to leave it on that note. Thank you guys. Right?
Funny.
Talk to Guido again. So on that note, guys, make sure that you're reading contracts. Make sure that you're getting your own contracts. Have attorneys look at it. That's part of being in this business and being serious about it. And just CYA, really.
Just do it the right way too. I mean, we've been spending it's almost a year for the contract we've been working on. We just want to make sure that it's done correctly, and we're doing it in a way where we want to put our investors first, make sure they're protected. It's not so much about the profit. It's more about everyone's protected and done the right way. So
absolutely.
The last thing you want is a bad reputation in the industry where people are talking about you poorly because you're not performing for them on what you agreed on. And we see it all the time. We don't want that. We're trying to build our brand as a trustworthy brand, and we will always put our investors first, to the point where sometimes we take a hit. But not everybody does that. But we feel that if we continue to do that, we'll continue to grow our investor base, and eventually that might move into a larger fund or something. So that's kind of our play and where we're headed with everything.
One last thing, you guys. So Joe said something really, really great, that they put their investors first, when they're always, where sometimes they're willing to take a hit. So one of the things is you have to realize is that notes is not real estate. There is a possibility that you could take a loss. Nothing is guaranteed, and it is an investment. You can't expect to get a 22% return on a performing loan, get those payments, and then when something becomes unsecured, now you want your money back. It's a risk, and you have to understand that there's a risk that is involved. And generally that happens more with seconds than first. So I want to, again, the glitz and the glam is great, but when you start taking a loss, you can't go hold Wall Street up. You can't go hold them hostage, tell them you want your money back when you've lost something on Wall Street. So stop acting like people are intentionally taking advantage of you. Some people are, but sometimes in this space, there's going to be a loss, and you have to look at your overall portfolio and not look at it on a loan-by-loan basis. Just one.
Yeah, and it also comes down to understanding what you're getting into. What am I getting into? What are my potential returns on this? What could potentially come up and hurt these investments? I mean, there's all kinds of issues that could come up, but it all comes down to communication. Whoever you're investing with, communicate with them. And if they don't communicate with you, then you're with the wrong person.
Mm-hmm.
With that, this is LOI signing off and saying CYA.
Bye-bye.
Cheers.